Hi everyone who's joining us. Welcome, Happy New Year. Just give a minute or so to welcome everyone in. Maybe people are finishing work, it's 5 o'clock, but yeah, thanks for letting us all know where you're tuning in from. One that's jumping out as one I'm jealous of there is Cyprus. It's quite cold where I am. Oh, I'm in Suffolk. That's where I am. Someone else is tuning in from Suffolk.
Well, I'm tuning in from Oxfordshire and it's very chilly here.
I'm in Dublin where we have snow and ice.
such a British welcome to a webinar. Cool. Well, I think we'll get going because we've got a huge amount that the three of us want to squeeze into our hour, and we're going to try and make sure we keep it to an hour. So we'll get going. So yeah, welcome everyone and Happy New Year. Thank you for joining us in this roundtable. I think this is the first or one of the first webinars we've done, which is more of a roundtable, the three of us. And the aim for this is that we are going to look ahead to 2025, looking at the stocks and the sectors and the general trends to watch for in 2025. As always, not advice, do your own research, but get your questions in. So I can see a lot of you have familiarised yourself with the chat box there on the right-hand side of your screen. So yeah, use that to get your questions in. We've got Sam and Lawrence with us in the control panel, so they'll flag any questions that you have to us, and we'll try and get through as many of them as possible this evening. For anyone who hasn't been to one of these webinars before, I'm Megan. I'm the head of content here at Stockopedia, and I'm joined by Ed, who's our chief executive and one of the co-founders, and Graham, who is the company's analyst. He covers the daily report every day, and it's starting to pick up today in terms of news. So I think Graham's life is just about to start getting quite a lot busier. Quick agenda for the evening. We're going to run through our model portfolios. As a company, we've got a few different model portfolios and watch lists, so we just want to familiarise you with them. And then we're going to run through, we've got 5 themes that we've picked out that we think are going to be interesting in 2025. And finally, if we've got time, we're just going to come on to a little bit portfolio construction. We've all got slightly different approaches to portfolio construction. And really the main theme of this evening is which companies have we got our eyes on for the year ahead. So we'll try and get into as many companies as possible. So just to very, very briefly run you through what our portfolios and watch lists are. A lot of you will know, have seen before Ed's NAPS process, Ed's NAPS portfolio. He'll talk to you about it in more detail in a bit, but just to flash up here on the screen, these are the first 10 of the stocks in his portfolio, and these are the next 10. So 20, very well diversified portfolio. As you can see, it's covering all 10 of the industries within the London Stock Exchange. Graham has put together a watch list. He does this every year. Bit more of a bottom-up approach to stock picking than Ed's QVM portfolio. 10 stocks on this list. You can see them here. Well, I'll share the slides. The slides will be available. See, we're rushing through this quite quickly. We also ran through 12 stocks of Christmas this year. The first time we've done this, and it was quite good fun. Graham, Mark, and I contributed 4 stocks each, so they're there. And finally, Roland has his stock in focus portfolio, which we've tweaked slightly to give it more of an income focus this year. So there are 16 stocks in that portfolio at the moment. He runs it quite actively, makes about 4 trades a quarter. Yeah, those stocks are there. So that was a quick run through of the stocks, the various stocks. I mean, it's more than 60 that we've got as a collective that we're interested in. So obviously not going to be able to cover them all this evening, but yeah, they're all there. They're on Stockopedia if you want to look into them, and we'll try and cover a few of them this evening. So on to the themes for 2025. So first theme, the outlook for the UK market. I'm just going to stop sharing the slides because it's more of a discussion. We'll bring them back up if there's anything, if we've got some good slides, some good visuals to show. But first question, I guess, take it in turns. Ed, we'll start with you. What's your general feeling about the outlook for UK markets this year?
Well, I'm not somebody who likes to make predictions. I think I generally tend to follow the some sort of technical rules of thumb on markets, and generally I've always looked to the old principle of don't fight the Fed and don't fight the tape. And I think in the UK, much like last year, the UK market is ticking up. In general, AIM has been down over the last year, whereas all the other major indices have been improving. And my view is, long UK equities, if we're talking about the UK, because they're very undervalued. I'm sure we'll talk about some of the, indicators of that undervaluation in a moment. And, being dominant with a kind of UK subscriber base, it's always good to sort of feel that there is a bit of a bid under the market. Now, obviously, the UK hasn't done as well as some other foreign markets. I'm sure we'll talk about soon. But so I'm fairly positive on UK equities, even though there's a sort of doom loop on some of the political and economic indicators, because I think the valuation is just too cheap. So and I think over the last 12 months, what we've seen is that good quality companies, good quality stocks have done very, very well. And I think that's, if you look at Graham's watch list last year, what was it, Graham? 23%, 28%, something like that in the last 12 months. Do you have the actual number?
Yeah, I'll have that for you in a moment.
Okay. So, and then my NAPS portfolio was up, 90, almost 20% last year before dividends. So good quality UK companies did very well in the last 12 months. And I don't know. I don't like making predictions because you can always be wrong, but it feels like it's a time to be long. So, and I know that there'll be those. The real trouble is if America catches a cold, or if isn't it America sneezes and the whole world catches a cold. So I think that's a risk factor there.
Yeah, absolutely. Graham, let's say same general question to you, I guess. Feeling positive about the outlook for the UK?
Well, I'm outlook on UK stocks. The economy is obviously very complicated. But to answer Ed there, my watch list was up 32% in 2024, including dividends. And really, that was just about, I had two very big winners on that list and no big losers. The big winners were CMC Markets and Trustpilot. But yeah, my outlook on stocks is positive because, well, firstly, valuation. And secondly, you can see this constant stream of takeover bids, which I think it's fair to say is continuing. Even today, we had two buyers for Team Internet Group, TIG. We also had bids for Ground Rents Income Fund with a cash offer. So that's just today. I know it's a coincidence, but we've got this constant stream of bids. We also have buybacks. It wasn't always the case that the transaction in own shares or buyback RNS was the most common one, but that is the case every day now, this constant stream of buyback announcements. So we've got... Go ahead.
I think it's amazing in my portfolio, putting it together at the start of the year, how many of those 20 shares had buyback programs on right now. The companies are eating themselves. They're buying their shares more than I've ever seen in the UK market.
Yeah, and I think it's totally rational. And I know it's a controversial topic. I know a lot of readers, have different views on the subject. And, I am not somebody who uncritically supports buybacks. There are plenty of buybacks that I don't support. But I think when you've got the market generally in small caps being depressed, it does make sense for many of these companies to buy back at least some of their shares. So we've got two really supportive forces at work there. And I think given the valuation generally, that makes sense. So I think I have to be positive on UK stocks.
Well, that's good news, good positive place to start. And I think, Graham, that general positive outlook about activity in the UK markets has fueled a few of your picks for the year. Do you want to talk us through your some of your financial companies that are in your watch list?
Yeah, so I've actually bought shares in Impacts Asset Management recently. This is a stock that I was very skeptical of when it was trading at nearly £15 a share. It was over £14 a share. This is an environmental fund manager, and it has had quite a lot of bad news over the last few years, but the shares are now down at £2.40 versus the high of £14. And when I'm studying fund managers, I often calculate assets under management versus the market cap. So at the peak, you got £100 of AUM for every £1 invested in impacts. At the peak, you got £19 of AUM for every £1 invested in impacts. Now you get £100 of AUM for every £1 invested in it. So it's basically trading at a fifth of the valuation in terms of assets under management. Obviously, it's not all rosy in the garden. It is suffering outflows, but it's trading at 8 times earnings. It's got a very credible management team with the founder still running it. So that's an example. I'm not sure how much more detail we should get into, but I also have a positive stance on Polar Capital, which is a really high quality fund manager, which is one of the very, very few which is experiencing inflows. And that's much more expensive, but a really, really strong reputation in technology and healthcare, and it's diversifying. And there's a few others in the sector I'm not quite as positive about, but the fund management sector generally is very interesting if we eventually see some inflows. Of course, some people will argue that fund management is dead, but that's a stance.
Well, it's a very interesting contrarian view, isn't it? Because I think a lot of these have been so beaten down in the last few years, and especially with this big bear market in the last few years in UK equities. So I know you're an ex-fund manager, so that contrarian stance, when the money starts coming back in the market, they should have a lot of operating leverage.
Absolutely, because they have capacity that's potentially 3 times larger than their current assets under management. So you've got all that capacity waiting to be used if investors can be persuaded to use it.
Cool. So there we go. There's pick number 1, 1 and 2, to be honest, Impacts and Polar Capital. We're going to move on to theme 2, very, very linked. And we kind of briefly touched on it there. The role of politics. This is an inflation chart not falling as fast as the Bank of England would like it to be. And we saw yesterday the trading update from Next. Graham, I think it might have actually been, well, maybe was it you or was it Roland who covered Next yesterday?
Oh, we argued about it. In the end, I covered it, and Roland covered something else he was interested in.
Was the I assume the argument was about you both wanted to cover
it. Something like that.
Anyway, this is the screenshot from there. As always, very, very good, very clearly laid out Christmas trading statement. And one of the things that jumps out is the fact that the company's saying that the increase cost that's going to come from the national insurance changes, which are due to come into effect in April, might have a continued impact on prices because Next and its peers are going to have to pass on these costs, these additional charges, which means the cost of goods that they sell might be getting more expensive, potentially feeding into further inflation. So on this sort of more general political point, I think there's a lot of strands to look at here. But firstly, on that national insurance on national insurance situation. Graham, what are your thoughts on the impact that this might have on the markets?
Yeah, well, I believe we've covered this before, but what really struck me about Next, and I should say I'm a shareholder in Next, I have been for many years, what really struck me was the clarity with which they presented that data. And they were presenting it from the point of view of quantifying how much these higher employment costs were going to affect them. I think something like £70 million on an annual basis. And they were looking to mitigate about half of that through mechanization and just greater efficiency. And I do trust that Next will be able to mitigate some of that additional cost. But it was just interesting because, again, I respect their management team so much. I really listen to what they say. They were being very cautious about 2025 on the basis that, while they didn't say this explicitly, but they will be mitigating national insurance. But they're worried that other companies more broadly will struggle to swallow those costs because it's, the national insurance threshold, that change alone is increasing the cost of having a part-time low-wage worker by 6.5%. And then you throw in inflation and other factors, it's about a 13% change in 1 year in the cost of having a low-wage part-time employee. So if that is going to generally affect a lot of companies, Next are worried about what that will mean for inflation and for employment. Next themselves are going to increase prices by 1%, and they're still able to control prices quite well. But I think other weaker companies may not be able to do that. So that does imply upward pressure on inflation.
Yeah, and I think it will be interesting to see in April when these changes actually kick in, how much of an impact it has.
Well, no, I just thought I'd just chip in here. I think one important framing point on some of the stocks that Graham will talk about and the ones I'll talk about. I'm very much more of a top-down investor. I use the stock ranks on the site to construct portfolios, and so anything I talk about, I often have far less knowledge about the individual companies than Graham would. And Graham is doing daily company reporting in the daily stock market report on the site with the other analysts. And it's really interesting because it does give you kind of complete different perspectives. And I thought one thing that was very interesting in the NAPS portfolio this year is that two retailers came up that I would never, ever look at before. One was Kingfisher and the other was Currys. And Kingfisher's been kind of hammered in the last 6 months. It's back where it was, I think, last March. And obviously with all of the national insurance rise and everything else, these are tricky times, and Currys has been taking a hit too. And they're obviously big retailers that, Kingfisher has Castorama in France and B&Q here and Screwfix and company, lots of brands. But it's interesting that that it started coming up on the stock ranks as highly ranked. And it might be they're the dogs of the portfolio this year, but maybe there is something there for contrarians because, the stock market is a discounting mechanism. And sometimes it tries to discount what is in the future already. But I think a lot of us think that things might be worse from March, April onwards than is currently perceived. So that would be very interesting to see how it plays out. But Kingfisher on a stock rank of 97 at the moment. I think Currys might be around the same level.
Yeah. The other political theme that'll be interesting to see how it plays out is sort of collectively calling it the Starmer effect. Sort of the planning, house building being one of the things, and also just general green initiatives. Ed, you've got a couple of stocks which in your QVM portfolio that play into these themes, but more generally, is it something you're interested in?
Yeah, I think there was a question that came through. I think you flagged it yesterday on that there were no house builders in the NAPS portfolio this year, and no construction materials or construction sort of services companies. And I think in previous years that's benefited a lot from some of the rises. But we've seen, maybe I should just bring up some of the house builders actually on the screen, because they've been absolutely hammered recently. If you look at companies like Persimmon or Taylor Wimpey or Barrett Developments, those kind of companies, they've had a huge slump. I was looking at it earlier today, 30 to 40% declines, and the stock ranks are much lower now. They're all at around sort of 65 or so. And I'm sure a lot of people own these shares. And it's really interesting because obviously there was a big story on that sort of the government were going to, they're doing their big build, Starmer's big build, doing all the planning changes. But it's the demand side that's really the issue here. With rates coming down more slowly, that's really kind of impairing demand. And I think we saw a new high on 10-year rates today in the UK. So that is kind of tricky on the demand side. And we're seeing all those house builders being hurt a bit. Whether that 1.5 million target on house building can be met, I'm skeptical. But maybe it's a contrarian time to be investing in those companies. I don't know. The one that's doing very well is in actually Roland's portfolio, Cairn Homes, I believe. And that's obviously an Irish house builder. And that one seems to have sidestepped some of those issues, as you can see, and still with a high ranking. But the other thing you flagged was on some of the net zero policies. And I don't pretend to be an expert, but one of the companies that came up in the NAPS process was Journeo, which is actually one I do own myself. And Journeo it's a small company. So some of these companies are quite small. It's only a 50 million cap stock. But they do telematics and fleet displays and a lot of the displays in railway stations. The government has a lot of initiatives, and the Tories and the Labour government, on sort of zero emission bus replacement. So there's 40,000 buses that need to be replaced and with electric vehicles, and other local service improvement plans. And so this one, interestingly, in the tech sector, and you'll be talking about tech in a minute, I'm sure, in the US. But this was the top ranked stock in the tech sector in the UK. And it just shows how thin the tech sector has got in the UK. Because the other one that's in the portfolio is MTI Wireless Edge, which is really an Israeli antennae company. And there are so few tech companies listed in the UK now. So anyway,
say that makes me feel a little bit sad that those two are the best tech stocks that we could come up with.
Well, I wouldn't say they're the best tech companies. They might be that they're
best tech investments. It's a lesson you taught me, Ed. A good company doesn't make a good investment. But yeah, so Journeo is one, and the other one that I know you were quite keen to talk about, and this is another one that you actually share with Roland's portfolio, is U Group. Yeah,
so U Group has been an absolute rocket in the UK market in the last few years. And in the utility sector, this is quite kind of rare. U Group do a kind of a range of utility services, from gas, electricity, water, to the SME and corporate sector, not to retail. So we wouldn't necessarily know them if we're kind of looking for our own sort of energy utility services. But they've been really building up a huge head of steam in a part of the market. They've got 1.5% of the market, and they're trying to aim. I think the broker was saying they could go and shoot for 7%, because it's a really underserved part of the market, and they've been doing fantastically well. And they're also installing a huge number of smart meters, which kind of gives a lot of lock-in and a lot of feedback from a data perspective back to the company. And they had like 120% growth in installations on smart meters in the last year. And you can see this kind of multi-bagging from beginning of 2022, from 175 to now 1900 pence. So it's 10 bagged over that period. But of course, there are risks here. In high growth companies, you often get quite high sales cultures. And one thing I have noted is that the Trustpilot reviews and the Google reviews have not been very high, which worries me. But I think if you look at the numbers, the PE ratio is only 9, and the growth rate at the moment is forecast as lower, but it's had a tendency to beat forecasts quite significantly. So I think this is a very interesting company that has strong momentum, but there is that risk factor that, are the reviews telling us something in the future? But it's very interesting. And also both the companies I just mentioned, both have 25% of the market cap in cash. So, if you look at the valuation ratios, that's actually including quite a lot of cash on the balance sheet. So yeah, quite interesting.
Absolutely. Moving on though to our next theme, which generally around the dominance of the Magnificent Seven in America. We have had a more specific question from a subscriber about the US market in general, and this is more, again, a little bit more of a political, economic question, broader, high level. So Graham, I don't know if you have any kind of comment on what's happening. We've still got relatively high bond yields. The base rates are falling, but they're not falling as quickly as we may have expected this time last year. What's your general perception on what's happening in the US and the outlook for the market?
Yeah, so once again, I feel more confident talking about the stocks in America rather than the economy, because the economy seems so complicated to discuss. But in terms of the stocks, I can confidently say that there's a lot of complacency out there. I think that the rise of passive funds has led people to treat the S&P as a sort of a magical asset that always goes up and to the right. And I think it's now a self-fulfilling prophecy as money just keeps piling into it. And one of the risks that has developed because of this complacency is that the passive ETFs are no longer diversified. Something like 40% of the S&P is now the Magnificent Seven. You're putting 7 or 8% of your money into the likes of Nvidia and Apple if you buy an S&P ETF. And when you look at the valuation multiples there, you're talking about 30 times earnings in many cases. I think they're Apple, Nvidia, and Microsoft are all about 30 times earnings. Now I'm a Berkshire Hathaway shareholder, so it was quite interesting to me to see that Warren Buffett or Berkshire Hathaway has been selling Apple in Q4. I think that's a good move, and yeah, I just think it's a bit like the Nifty 50, which was a concept several decades ago when people thought you could buy these blue chip stocks and it didn't really matter what you paid for them because they were such high quality. I think we're at those levels of complacency now where future returns are likely to disappoint.
Ed, any alternative view? Do you share those concerns?
Look, I have to admit, I am more of a value investor, but one thing I have learned through time is that I'm quite good at predicting the future. It's harder to profit from it, which is why I always use factors and the stock ranks to generate portfolios, because they're very reliable. And I've had a tendency when I try and predict the future to shoot myself in the foot. But I can see that look, the AI train is going to run and run and run. I think one good analogy for this, which I read up recently, somebody was saying it's like the rollout of mobile networks. These LLMs are going to be like utilities, and application developers are going to be a huge amount of the value in future. So, and then of course there was that mention of by the CEO of Nvidia about that we are just about at the inflection point on robotics using AI, and I mean really the implications of this are vast, and I think that really it's how much of the big concern here is how much of the kind of worker base is going to be displaced by AI, and I think that's a very, very real thing. It's going to be possibly very good for company profit margins, but not very good for the workforce. So look, I'm not going to make a call on Nvidia, and I think a lot of people have made a huge amount of money on Nvidia, and I know you're very bullish on it. And I think the infrastructure rollout can run and run and run. So I'm sure that the profits are going to come for a long time, but it's how much growth is already factored into that share price, I think is the big question. And how many years will it take to actually catch that up?
Yeah, I do agree with that, but my personal view is that I don't think that time's going to come. I don't think that's going to happen in 2025. I think there's still so much optimism in AI, and there's still so much genuine growth happening in AI. I mean, we saw as part of his keynote speech, the chief executive of NVIDIA on Monday evening talking about some of the new deals that the company has signed recently, and they're mega deals, like providing the chips to Uber's autonomous vehicle rollout. And if Uber does get its autonomous vehicle rollout right, and NVIDIA is at the heart of the chip providing of that, then that's a big old deal. But I do completely agree with you, Graham, about the potential overweightness of some of these stocks. I mean, we saw NVIDIA fall on Monday night, fell 6%, and 6% in NVIDIA is more than the market cap of every single stock in the UK. It was a $220 billion fall from, I mean, what seemed to be mainly profit taking, and also the fact, I think, that the chief executive had said that one of the big developments is going to take quite a long time to roll out. But I think that kind of shows, Graham, what you were saying about this sort of virtuous circle. It can turn into a vicious circle if the money starts coming out of these companies. They're currently, as you say, 40% of the S&P 500. It could start all unraveling the other way, and that might be a little bit concerning. I do have a pick though outside of the Magnificent Seven, and that is Garmin. So it's still a tech company, but more a hardware company than a software company. Got a very high stock rank at the moment, strong momentum, good earnings growth, beating expectations. It's not cheap. I'm less of a value investor than my colleagues here this evening. But I think there's more good to come from Garmin, especially it does have an angle into the autonomous vehicle market, because it's a satellite navigation and GPS tracking is where it is an expert. And yeah, that's my pick of the US sector at the moment.
And do you use a lot of their products, Megan?
I do. Well, I say a lot of their products, but one product in particular. It's great. My Garmin Forerunner is a brilliant product, and the app is a free app. But I use it to track my training. I'm London Marathon training at the moment, and if my Forerunner were to reach the end of its life, I have no doubt that I would stick with Garmin because, well, firstly, I think the products are brilliant, and secondly, because all of my data, all my training history is in their apps. So that is quite a nice barrier to entry for others. Because once you've got a Garmin, I don't think you're likely to go anywhere else for your training.
It's very interesting, these companies, because I think Garmin's in the S&P 500, isn't it? Mm-hmm. And I think what Graham, you were saying in terms of valuation, that's a forecast P of 27, and you're not getting a lot of growth in there, but it's very consistent growth, isn't it? You've got 9% revenue growth over the last 6-7 years annualized, and profit growing at 13% annualized. So they're a very, very consistent long-term compounder. But it's for UK investors, like the valuations always seem so punchy, but it's that reinforcing kind of one of the subscribers called it this sort of sucking black hole of American of global and local and domestic American capital into passive indexing, which reinforces the higher valuations of S&P stocks. I think it was David Einhorn I was reading recently who said they've given up buying P10 shares in America because there's no buyer for them. You have to buy more expensive companies to benefit from valuation in being enhanced through indexing. So they're either buying stocks at PEs of 4 or 5 because those companies will buy back their own shares and spit off cash flow, or they're buying very premium stocks that will be candidates for the index and others. So it's a really fascinating dynamic in America, and it's very sort of structural and sort of almost technical. But I don't know if you've got any thoughts on that, Megan, because I know you're a big US investor, and how do you soothe the nerves of of sort of typically value-oriented British investors on investing in these things?
I personally, I mean, investing for the long term, and yeah, I mean that's the 10-year share price chart. There was obviously a bit of a blip, which did last a relatively long time, and now coming back up again. So yeah, it's been a consistent long-term compounder, but it's not one of those charts that just goes up and up forever. So maybe not the best one to soothe the nerves, but it is one thing that I do think is very impressive about Garmin is like we're saying 9% compound annual growth rate in revenues over the last 5 years and 13% operating profit. Those are the kind of consistency of growth that we'd love to see in UK stocks. And I think if we were to see them in UK stocks, they would be trading on similar valuations, because I mean it's an impressive result. I think what's particularly nice about that is when operating profits are growing at a faster rate than the revenues, there's good operating leverage there, and Garmin certainly does have that. Last year, the company was able to report higher revenues at a lower cost of sales, which is, I mean, just an amazing statistic that they're actually able to grow revenues by spending less. And that's partly because they're getting more of their marketing done by word of mouth marketing. More people are spending more on new products. Once you've got a Garmin watch, if you start playing golf, you might get a Garmin rangefinder. There are lots of products within the Garmin universe, and I do think that on the hardware side, it is a bit of a comparable with Apple's hardware, which is, everyone knows that once you're in the Apple universe, you stay in the Apple universe. Maybe a little bit more niche than with Apple, but yeah, they've got great products and they're great metrics. And I'm optimistic. One other thing about the company is it is quite well diversified. Even though it is a tech hardware company, it does operate in multiple sectors. So yes, it's got the consumer facing division where it's selling watches and rangefinders and outdoor equipment thingies to people who like doing that sort of thing. But it also sells to car makers, it sells to companies in the aviation market and in marine, and that has been where the growth has come from, at least in the last couple of years. So yeah, some diversification within the company as well.
Cool.
So let's move on to, let me find my slides. Our next theme, which is gold. Ed, did you correctly?
I think I did.
Yeah.
I thought it was a spelling mistake.
No, the correct one is glisters, but that's all right. Well,
right.
I
thought it was glisters, so I wasn't sure if you wanted glistens or glitters.
No, it's okay. Well, it's fine. It's fine we're talking about gold anyway. Gold spot price hit its all-time high in October. Ed, how to gain exposure from this rising price? Obviously, you can buy gold, but
well, exactly.
Stocks here.
Yeah, there are. I think the rising gold price has been just fascinating and thrilling to kind of watch. I've been tracking gold since we started a family investment club in 2004, and my father has always been a huge gold bug and gold and silver bug, and it had that wonderful long-term bull market up until it started a decline after sort of peaked out in of course, Gordon Brown sold not all the gold, but a lot of the British gold right at the bottom before it took off, which is a much mocked trade, and now it's on the turn again, and it's broken out and it's got huge strength, and I think it's really a function of there's been a lot of money printing, and when fiat currencies devalue, hard assets improve their value. The stockpiling of gold in all the kind of BRICS countries, because they don't like the dollar being the reserve currency of the world and all the kind of dollar weaponization that goes on, and really they'd much rather have hard asset backed currencies. So there's a lot of demand out there, and it's what's really interesting about the whole really all hard asset sectors, and you'd include any mining companies and really the oil sector too, is that they've been very underinvested in. They've been starved of capital. You look at all these fund managers that have sucked in lots of AUM. Let's talk about, obviously some of Graham's faves, like Impacts. It's called Impacts because it's an ESG asset manager. And I think Liontrust have huge ESG weighting too, and so that ESG train that went right through the 2010s sucked in so much capital, and therefore there's been a huge amount of underinvestment in a lot of mining companies. And as we see those base metal prices sort of rise, there's a lot of profitability can sort of flood through to the miners. And so anyway, I just think it's an interesting one because it did surprise me last year in the NAPs. Metals exploration, I think, was the top performer. I might just bring that up actually, if I can. So there were a couple of gold miners in the NAPS portfolio, and I don't pretend to be an expert in either of them, but I know that Sarabi Gold was also in Mark's 12 stocks for Christmas, and Sarabi is a sort of Brazilian gold miner, and I think it's. You look at this and you look at the numbers and it's extraordinary. You've got EPS growth forecast at sort of 60% and a 2.6% forecast PE ratio. It's got a very high stock rank, and they're a Brazilian miner, and they've got their mines and they are spitting off cash flow, and they've got quite a good setup there. There is a bit of a question mark on the license. They don't have a full-time, long-term license. And there's a little worry, will the Brazilian government sort of make a play here? And I think that may be one of the reasons why it's maybe not as valued as highly as it should be. But I also think that the company's benefiting from the rising gold price, a weak Brazilian real. And, if you look up on it, I don't know if anyone's got a subscription to Research Tree. There's some great broker notes on there. And also is one of Zeus Capital's top picks for 2025. So interesting that came up in the NAPs. And the other one is metals exploration. And I think this is quite an interesting story here. It's got a takeover. It's trying to buy out Condor Gold at the moment. Because metals exploration mostly operates in the Philippines, but actually their Runruno mine is depleting. And they've been making huge profits the last couple of years. And if you look at the share price, it's been, really barnstorming over that period. And you can see that the share price really rising. Still a 99 stock rank, very low price to earnings ratio. But if you actually go and look at the profits, you will see that they've kind of peaked out in the trailing 12 months, and they are forecast to start declining. Now, there's still a lot of profits to come from that mine in the Philippines. What they're trying to do is use all the cash flow to buy up other exploration licenses, and they've acquired sort of Condor Gold. That's all going through. So, but they're operating Nicaragua. So there's a question mark there. Can the company use all its cash flow to really sort of build a more enduring gold mining company? I'm not sure whether that's going to be the case. So, but anyway, they're both in the NAPS portfolio, just purely on the basis that they are in the basic materials sector and they have the highest stock ranks. So, do your own research. And there's another kind of interesting one in the UK market, which was almost made the cut, is Altin Gold, ALTN. And so these are all quite small cap gold miners. If you wanted a safer play on the UK market, you'd be looking at something like Hochschild Mining, HOC, and but I think the whole sector is quite interesting because their cost bases are, I'm not sure what metals exploration's cost base was, but they generally have cost base at about sort of $1,000 to $1,300 or $1,500 per ounce. And of course, the price of gold at the moment is $2,700 or $2,600. And okay, they're not normally selling at precisely the spot price, but even if they're selling at $2,300, you can see there's a huge margin for profits. So, never for, they're always risky plays, these, because we all know that commodity prices can be very volatile. But, when there are significant profits, they are very, very cash generative. And the share prices often reflect that.
Graham, this sort of sector generally isn't one that we tend to cover. I mean, there is a great deal of specialist knowledge that is required unless you're taking that top-down approach to investing, as Ed is doing with his NAPS portfolio. Would you ever be tempted by this this gold rally and other precious metals, commodities, things like that, to look at the miners as exposure to these kind of?
Well, I am a gold bug at heart. I think many of us are, but there's a safer way to do it, in my view, and it's H&T, the pawnbroker, trading at 6 times earnings, trading at a discount to book value. It's the market leader by a mile. Its pledge book is 10 times bigger than Ramsden's. I mean, what more can I say? I don't own shares in it currently, but for many years it was one of the largest positions in my portfolio. And yeah, I'm tempted to get back into it. The share price hasn't really done anything for 5 years.
It's interesting, isn't it? Because it definitely is a gold play, as you say, but while the miners are soaring higher, H&T hasn't really been benefiting from that rising price of gold.
Well, I mean, its profits are in rude health. It's really, in my mind, it's really just the valuation is the problem. Why is it not trading at 10 or 12 times earnings? If you look at the quality metrics, it's actually done a good job of producing a good return on capital, return on equity recently. And it's passing 2 of Ben Graham's screens. Both of them are value investing screens. So for me, that's how I would play gold. Somebody who understands mining better than me or is more automated could throw in some miners, but yeah, and I would pick H&T first rather than Ramsden's, because Ramsden's is more based on, I would say, having a bullish view on the consumer, because there's a lot of holiday currency exchange involved there, whereas H&T is if you're a bit more bearish or defensive, because obviously the demand for pawnbroking is kind of counter-cyclical with a weaker economy. But the stock ranked there nearly 90. Yeah, that would be my pick. Yeah,
I think I'd be with you on that. But yeah, that is partly because the miners scare me a bit. Finally, final theme, which is quite an interesting one, is sin stocks. So sin stocks being tobacco, gambling, oil and gas, the mineral companies, companies that are doing bad. Actually, would you put? I'm not sure. Actually, sin stocks being bad stocks.
It's interesting, isn't it? Because defense stocks were seen as, uninvestable for so many years. And then Putin invades Ukraine and suddenly everyone goes, no, actually defense stocks are kind of ESG. So yeah, funny how these things can change.
Absolutely. And as you say, aerospace and defense had a very strong year last year, driven a lot by Rolls-Royce and BAE. But tobacco also was a pretty strong sector. Ed, do you want to comment on that overall?
Well,
positivity in.
Well, I'm just off for my own sins, I'm just off a 2-year addiction to nicotine, and I got the flu before Christmas, and finally I managed to crack to stop vaping, having not smoked for like 20 years. So I know how addictive these things are, and I think I was looking at, because two stocks that are exposed to that trend are actually in the NAPS portfolio. One is Imperial Brands, obviously rebranded itself from Imperial Tobacco. And if you actually were to bring up the chart, you'd see it's done extraordinarily well. And I think you mentioned, Graham, that BAT, British American Tobacco, similarly. And Imperial Brands have the real growth part of that portfolio is all in their kind of new lines of nicotine products, which is sort of nicotine pouches and vapes and things. And of course, they are much healthier for you. They're much better for you, in theory, than smoking, noxious cigarettes. So, certainly the addiction to these nicotine is not going away anytime soon. And also you get huge, there are all these share buybacks. They're spitting off cash flow. They have huge buybacks. I think there's a $1.25 billion buyback for Imperial Brands this year, which is up 15% on last year. And it's got, 5% dividends. And, so these are very cash generative businesses, and they just go out of fashion for a very long time. And I think maybe that huge trend has been people starting to reallocate away from ESG. And the other one's that is in the portfolio is Supreme, which has been an extremely, a really terrific operator. I'm sure you guys have covered it in the reports over the last kind of couple of years. It's been quite fascinating to watch. I don't own it. And they're my understanding is they're a distributor of various brands to shops in the UK, sort of soft drinks, batteries, vapes. They started buying brands. They bought Typhoo, which had kind of gone into administration. But I think a huge amount of the profits in the last couple of years of Supreme has been through distributing vapes, things like those Elf bars and things, which obviously, and I think quite rightly, that the government have been trying to ban, certainly the disposable ones, because they're terrible for the environment and so on, and they all smell. And but they're just going to shift into doing refillable ones, and so they'll just corner the market in that. So I think it's a really a very good business in terms of its operating capability, and it's very cheap and so on. But you might not be someone who wants to invest in those sorts of areas. But I think. And I think a large proportion, you'll probably know better than me, but a large proportion of their profits has been in the vaping sector. So that is the risk.
Yeah, it looks like as Roland was reporting in November, vapes are well over half of their profits, even though non-vape should be about 45% of revenue. That was as reported in November before the acquisition of Typhoo Tea. But I just want to say, I think the acquisition strategy there is quite admirable. Buying a company out of administration, buying another drinks company cheaply without using debt. This is kind of what I'm looking for in acquisitions, getting them at good prices and not overextending yourself. So I've been pretty positive on Supreme, although like yourself, Ed, I don't own it.
Yeah. That's one of the reasons I think the valuation is so low, because I think a lot of people just think, it's the sin aspect. That's what we're talking about, right? It turns people off. And ironically, that's where often good stock market returns come from. I remember I was on Twitter a couple of days ago and I know it's now called X, but there is someone called, was it Aim High? Someone I follow, who was saying that actually it was all the sin stocks in his portfolio that drove all his return last year. So it is possibly something that will continue this year.
Yeah, and we were talking yesterday, weren't we, about the fact that actually last year and probably continuing into this year, the ESG drive is slightly less in the markets than it had been in the previous years, or as it was in the aerospace and defense sector. It's slightly changed. I think people maybe not necessarily thinking that defense was quite as bad as they had thought prior to the invasion of Ukraine. So yeah, it'll be interesting to see how that trend, that sin stock or maybe not so sinful, runs this year. So those are our 5 themes, and we've got about 5 minutes left just to quickly run through, more general portfolio construction. Obviously, we're talking about 2025 here, but most of us want to make money beyond 2025, and we're building portfolios for this year and beyond. So Ed, do you want to just quickly run us through the QVM or NAPS portfolio and how you put that together?
Well, yes, that portfolio is very, very simple. It's ranks the market by stock rank descending and picks really essentially 2 by 2 from each sector. It's not precisely like that, but that's pretty much the essence of it. And so generally is diversified across all 10 of the major economic sectors that we publish on Stockopedia and categorize stocks into. And I think what's been fascinating about that over the last 10 years is I've never been able to really predict which sectors are going to do extremely well from year to year. And I think one of the reasons that portfolio has performed so well over the decade it's run, it's done about 13% annualized, which has turned pound into more than 350 over that decade, and dividends on top. So it's I think one of the kind of key things in there, because it's outperformed the stock ranks as a whole, the 90 plus cohort stock ranks. And I believe one of the reasons for that is that slightly more careful portfolio diversification across all the sectors. One thing that I've found when people sometimes join the site, they look at their portfolio and they realize actually they've got everything in one or two sectors, and that actually is just one sector bet, or one or two sector bets, rather than it being, which actually creates quite a lot of risk. And as private investors, we can often be very pro-cyclical. We can invest, we might be all invested in AI or peak oil or, cloud computing when it's running hottest. And then, of course, because the media all says, yeah, this is great, or dot-coms in 2000. And then, of course, they reverse. And so diversifying across sectors that are kind of a little bit counter-cyclical, I think is so important. So any of the things we talked about today, I think it's very important not to just go all in on one thing.
Great, thank you. And Graham, your approach slightly different, looking more at the companies first approach.
Yeah, but I think what I'd like to highlight is actually, of the 10 stocks that I ended up putting on the watch list this year, there are some very high stock ranks in there. For example, IPF 99, PayPoint 98, CMC 95, Polar 96, and even Nichols 88. So half of the watch list is extremely high stock rank. I think I do take a bottom-up approach. Of course, I try to stay within my circle of competence most of the time, such as it is, and that's why I have a lot of financials. But when there are companies, non-financial companies that I spot something in, I definitely will go for it. Like I went for Trustpilot last year. I had a lot of interest in that one. I'm still pretty positive on the drinks companies, Nichols especially. So yeah, I do take a bottom-up approach, but I think I love getting that quantitative confirmation, and I do get quantitative confirmation quite regularly.
Cool. And you guys share one stock, similar. I know, Ed, there were a few that Graham just mentioned that nearly made the NAPs, but the one stock that overlaps is International Personal Finance, IPF, which you mentioned, Graham. Do you want to give a very, very brief summary of what International Personal Finance is, Graham?
Yeah, sure. Well, this company provides home credit in various European countries, and it's also in Mexico. I've written up an entire little report or little article about this in the 12 Stocks of Christmas, so people can go there and read that. I acknowledge that it's risky. People will want to avoid it when they hear that it's subprime customers and it's in Mexico and in Eastern Europe and all the regulatory risk. I mean, I totally get that people will avoid it, but then I've been following the company for years, and it's currently trading at 6 times earnings, 6% dividend yield, big discount to book value. I've bought shares in it myself recently, and I just decided to pull the trigger on it at last. And it's got a really well-aligned management team. I also interviewed the CEO of the company, and that's up on Stockopedia as well. I interviewed him in the middle of last year, and that was very interesting. So I think he's very well aligned with external shareholders. So that's just an example of what comes out of bottom-up research, and stock rank is 98 today, which doesn't hurt.
Absolutely. I would say that I share no choices with either Ed or Graham. My mixture of screens, stock ranks, and a bit of bottom-up research, and a love of quality growth means that none of the stocks that I picked have the kind of valuations that I think either of you would be comfortable with.
Well, I think it's something that Jim Slater said a long time ago. Even in the 90s, the number of growth stocks were starting to decline in the UK, and I think it's really, really sad for the market. Like, stocks are kept off market in private equity for much longer, and they don't really float, or they go to the US and float because there's more capital. But I love a great growth stock. I mean, that's kind of what it's all about. The lack of growth stocks in the UK kind of has made me kind of take more of a growth portfolio approach. And of course, you can compound a portfolio in the same way through just good compounding returns. But I mean, if you can find one great growth company, it can do all that work for you. There's one thing I just wanted to say, because there's a question that has come up, and it was really, how do you find these sorts of model portfolios and things on the site? Do you mind if I just quickly show people, just very quickly? I mean, everything we publish kind of goes on the homepage, so in this research section, but in the discuss section, you can actually use the filters on the sidebar. So you'll find all the 12 stocks for Christmas if you click screens and ideas here, and you'll find them all in the list here. And there's another one here called Stockopedia Portfolios, where you can then find some of certainly the NAPS portfolio and the Stock in Focus portfolio. So using some of these filters, and I think your watch list might be actually we probably should have that in Stockopedia Portfolios, but it's probably in the Daily Stock Market Report. I'm not sure. But you should go and explore in that sidebar, because you find a lot more content.
Yeah, so Graham's watch list is actually in the stock pitch section at the moment. But it is, model portfolios is something that we are very keen to expand, explore, do more with in Q1 this year. So keep your eyes peeled for all the stocks that we've talked about today, all of the watch lists, model portfolios, having potentially a more permanent home on the site, which will be easier for everyone to find. And also means that we can do more sessions like this and keep you up to date with how they're all performing, hopefully replicating the same kind of results that we saw in 2024. But thank you very much, everyone, for joining this evening. Thanks, Ed and Graham, for your contribution. We've managed to keep it just about to the hour, which I think we were a little bit worried about yesterday. Yeah, join us again. We've got lots more webinars coming up. And as I say, we'll try and tune in later in the year to check in with the stocks that we've picked. Have a good evening, everyone, and see you soon.
Great. Thanks very much.